When the final credit layer goes away, then everything breaks apart, and we're in a completely different world. I think AI goes away. I think all this stuff goes away. I've looked at AI's earnings and the fact that it's kind of getting stupider. It's not getting smarter. It's getting dumber.
If I'm right in my fundamental analysis and that we still have a long way to go with this market, then that argues for actually silver cooling off a bit here. Maybe it kisses 60, that sparks some profit taking and it cascades a bit. But, if silver crashes all the way down to 50, the silver miners will still be printing money, like literally pulling money out of the ground, real money. So I don't think that would be a disaster at all.
Take a slow breath, because what's happening in the gold and silver markets right now is unlike anything we've seen in over a decade. In the past few weeks alone, silver has surged toward $59, dropped back into the low 50s, and then snapped violently higher again, a pattern that normally appears only when physical supply is tight and market makers lose control of liquidity. Meanwhile, LBMA vaults just reported their lowest silver inventories since 2016, and India's silver imports have spiked to a 3-year high. At the same time, the CME FedWatch tool flipped from 27% to over 70% odds of a December rate cut in a single week, triggering billions into safe haven assets. And then came the bombshell. Italy is pushing legislation to declare its central bank gold as property of the Italian people, forcing the European Central Bank to openly warn against it. Reuters reported the ECB is strongly encouraging Italy to pull back, because acknowledging gold's importance exposes the weakness of fiat credibility. Rafi Farber says these developments are the early signs of final phase instability where the last credit layers begin to fracture. Lobo Tiggre agrees that pressure is accelerating, but warns that before silver enters its true explosive phase, it may need one last cooling dip, creating what he believes could be the final buying opportunity before 2026. Today we break down the data, the politics, and the pressure points, and what they mean for the coming silver bull run.
We are approaching the end game. I've thought we've been approaching the end game since 2008. So either, no, not in 2008. I was just waking up back then. But what's the timeline? I can't. I don't know. I've been wrong about this so many times, but I mean, gold and silver are moving so quickly in both directions. The volatility is increasing. And the last piece of news that I saw is that Italy, whatever their Congress is called, is set to pass a law or a suggestion or some kind of statement that the gold that's owned by the Italian central bank, which is now subservient to the ECB, but it used to be independent of the ECB, that the Italian gold now belongs to the Italian people. And then the ECB is like, we're strongly encouraging you to not say that. And then the funny thing is that they're damned if they do. I'm talking about the ECB, damned if they do, damned if they don't, because if they say, no, no, you can't pass that, or if they express any kind of strong opinion other than that, we strongly suggest that this is not a smart thing. And then in the article I read on Reuters is like, quoting some ECB official saying, I don't even know what this means, but we discourage it anyway because they have to pretend that they don't care about gold, but at bottom they know that it's what's backing them.
Right.
So if each country takes ownership of its own gold and hollows out the ECB in that way, it's basically what I'm preaching on the Endgame Investor. It's like you stack gold and silver not necessarily to make yourself rich or even to get through the end game or to make sure that your family's okay. All that is a side effect, and it's a good side effect. It's a welcome side effect. But
Right.
the point is, we want to hollow out the system because we don't want them to be able to inflate and spend money on lockdowns and pharma subsidies, maybe in 2013, 2014, something early on.
Hmm.
And Italy is a basket case. They have like the second highest debt to GDP in the world, I think. Maybe third highest, I think, is Japan, and then Greece, and then Italy. I think they have the third or fourth largest gold hoard, right? So once you see legislatures start to pay attention to gold and declare that they own it instead of a central bank, we're really getting to the core of the issue here because, as we say, gold and silver are money. The only problem is people don't want to admit it. And so they say, oh, it's just a hedge against inflation, or it's a way to protect yourself from tail risk, or it's a way to protect yourself from chaos. But like, why is that? Why is it a hedge against inflation risk? Why is it a way to protect yourself? Because it's money. Because but but you say that, you can say that over and over and over again, and it doesn't click until everybody starts seeing the value of their credit falling and falling, and they realize, well, this isn't money, it's not working, so I have to go back to money itself. And no matter how many times you say it, it's like you can only understand it instinctually,
Right.
right? Understanding it intellectually is one thing, but even if you could prove it, and I try to prove it, that's why I focus on the Misesian regression theorem or regression principle that all money has to go, all prices have to go into the past because they all have to be based on the past because otherwise prices don't mean anything. And if prices don't mean anything, you may as well be in a zombie apocalypse because if prices are meaningless and nobody knows what to do, and then they start eating each other.
Yeah.
So you can prove that intellectually, but even for people like us who understand it intellectually, we still think of the dollar or the Canadian dollar, the shekel or wherever it is you are. We still think of that as money because
Hmm.
we see our wallets full of that. Like you put gold coins in a wallet, you're like, like what am I in the 18th century? It doesn't feel like money. It feels like
Right.
I'm a whacked out crazy guy who's
Right.
like carrying a pouch of gold or silver with me, like in a like why am I doing that? Like that sounds nuts, and it
Right.
still sounds nuts to me. But intellectually, I know. But then when it doesn't, when the wallet full of digits, whether they're Bitcoin digits or fiat digits or whatever kind of digital data, whenever everything goes down and we don't have access to those digital whatevers or paper whatevers, then we're all going to start carrying around sacks of gold and silver. As crazy as it sounds, it's going to happen. Well, let's sharpen that,
Yeah.
okay? So they don't, first of all, they don't have any money at all because
Mm.
they only have derivatives and they only have credit derivatives. Even the dollar is a credit derivative.
Right.
But they don't even have dollars is just one is just like there's layers of credit. There's gold and silver, and then you start after gold and silver, you start the credit layers. Right? So they have credit, they have your credit, but what they do is you give them credit level one, like dollars or Canadian dollars, that's level one. And then they take the dollars and they give you credit level two, three, four without telling you that it's credit level two, three, four because they're using credit level one to generate more credit for somebody else.
Right.
So they have like a ghost of your credit in either debt to you or stocks held by a brokerage. Even the stocks that held in your brokerage, a lot of them are lent out. So the credit that you think you have in your brokerage isn't exactly that level of credit. It's some higher level of credit derivative. So it's like you have the reflection of what you're supposed to have.
Right.
But then when it all comes crashing down, it's the currency itself that is revealed as the reflection of gold and silver that it actually is. And
Yeah.
that's the final piece that nobody can accept, not even us, because still we don't want to walk around with gold and silver in our pockets, but we're still intellectually aware that's going to happen.
Hmm.
So when the final credit layer goes away, then everything breaks apart and we're in a completely different world. I think AI goes away. I think all this stuff goes away. I've looked at AI's earnings and the fact that it's kind of getting stupider. It's not getting smarter. It's getting dumber.
The behavior of silver and gold over the last 30 days is telling us something deeper than typical market volatility. The sudden bursts up toward $59, the rapid pullbacks, and the equally aggressive rebounds signal a market struggling to function under structural stress. According to LBMA data, global silver inventories have fallen below 840 million ounces, down almost 30% from pre-2020 levels. Premiums in Asia have risen sharply, and refiners in Switzerland are reporting longer processing times. These are textbook indicators of tightening supply, which Rafi Farber argues is the visible surface of a much larger systemic issue. Rafi's core message is simple. Every modern financial asset is built on credit, layers of IOUs stacked on top of shrinking collateral. When volatility spikes in both directions, when physical metal becomes harder to source, when central banks quietly accumulate gold, and when governments begin asserting ownership over gold reserves, those are the signs that the final credit layer is beginning to thin. The move by Italy to claim its central bank gold, confirmed by multiple Reuters reports, is precisely the kind of political trigger that exposes how vulnerable the fiat system actually is. Publicly, central banks pretend gold is irrelevant. Privately, they rely on it as their ultimate foundation. But Lobo Tiggre offers a crucial complementary perspective. He believes silver is entering a bull cycle, but warns it traditionally lags gold early before outperforming massively at the end. If silver spikes too fast now, outrunning its fundamentals, it risks entering the euphoric phase prematurely. That's why he sees a dip to $50 to $55 as not only normal, but healthy. At those levels, silver miners would still be printing money, and long-term investors would get one last chance before the real upside begins. Lobo is also watching macro catalysts. Rate cut odds have surged above 70% for December. AI tech valuations, Nvidia, Meta, cloud AI firms are trading at levels Bank of America calls historically stretched, raising real risk of a liquidity shock if that bubble unwinds. Meanwhile, U.S. government interest expense just surpassed $1.1 trillion annually. European rearmament is accelerating inflation, and Asia's demand for physical metal continues rising. Put together, the picture becomes clear. Geopolitical stress, structural inflation, tightening physical supply, weakening credit layers, and political battles over gold are converging at the same moment. That's why both Rafi and Lobo believe 2026 may mark the start of silver's largest revaluation in modern history, not as a niche investment, but as a mainstream defensive asset. The next pullback might not be danger, but the last chance.
It's kind of fun when, gold was breaking out and breaking out and breaking out. We had lots of gold headlines, and we talked about how that might bring more generalist investors in. It's sort of fun, but also a little bit scary to see silver headlines on CNBC or Bloomberg. There was a video that went around a couple of days ago about, will silver head higher? And it wasn't silver or gold bugs. It was one of these mainstream media outlets. I forget which one. But the funny thing was, it didn't tell us anything new, anything we hadn't heard already about the shortage in London of physical and people flying silver around, all that sort of stuff that we've talked about for weeks now. But people got all excited and people wanted to know, what do I think about this video? And so on. Well, I think they're telling us what we already know. But to answer the question, I think I have two minds on this. On the one hand, I'm long, and despite people calling me Darth Silver and all these things, I own plenty of silver. Plenty of silver stocks. I'm very happy to see it long. I've never been a bear. I'm not sure I really want to see silver catching up with gold because, even your most diehard silver bulls will tell you that silver lags gold at first in a bull market and then more than catches up at the end. It's not the catching up part I have a problem with. It's the end part I have a problem with. My analysis is not technical, it's fundamental, and I don't see any reason for this bull market. I'm bullish on anything real that governments can't print. I'm particularly bullish on monetary metals, safe haven assets. If you, dear audience, think that the AI valuations in the market are a bubble, if that bubble pops, I think that would create a lot of demand for safe haven assets. As we all know, if the market actually crashes, I'm not just talking, rolling over and politely, slumping down to more reasonable valuations. If there's an actual crash, everything gets whacked, absolutely everything, including gold at first during that initial liquidity crunch, and then it goes soaring. If that happened for anybody who gets it, that could actually be an absolute gift on the part of the market. That sphincter's opening moment, like in 2020 or 2008. I wasn't in the market in 1987, but I understand it was a similar thing, right? The wrong things go on sale, and that is an absolute, the best times you could have bought gold in my career or during the crash of 2008 and the flash crash of 2020, both of those saw screaming rebounds afterwards. So we might see something like that if the AI bubble bursts. And if not, broadly speaking, I think the writing is on the wall of the inflationary agenda in the United States. Even if you agree with Trump, the Doge did not save us $2 trillion. Tariffs are being walked back and negotiated down. So I think the agenda is highly inflationary. Europe's rearmament is highly inflationary. Russia's war is highly inflationary. Even China, at long last, has finally got some consumer price inflation going again. So, that's bullish for monetary metals. And then to sort of the not just the geopolitical risk, but the awareness of how rickety the financial house of cards has gotten. I think, I can't prove this, but I think it has a lot of mainstream investors, deep-pocketed, not just institutions, but individuals, family offices, that sort of thing, saying, maybe I should hedge with a bit of gold and maybe some silver too. So all of this is very bullish, whatever happens long term. And I feel a bit odd saying this when we're at or near record prices in gold and silver, but there's actually not a very strong case for gold going down. The strongest case we could have made recently was, gold went screaming up to 4,400. That was too fast, and it has to be a correction. And then the question was, would that be a peak, or would it be a plateau to another high later? And I wanted it to be a plateau, but Mr. Market doesn't care what I want, right? So we had to see. And I think it's pretty evident right now. It certainly wasn't this kind of peak. It wasn't a 1980 intraday type peak. It looks like 4,000 is the new 3,000, and we're consolidating before moving higher. So overall, bullish, bullish, bullish all around. It's a crazy thing for me to say at these levels, but that's the way I see it. And sorry, let me come back to the point of your question. If I'm bullish on gold and I'm bullish on anything real, how can I not be bullish on silver, right? That having been said, if I'm right in my fundamental analysis and that we still have a long way to go with this market, then that argues for actually silver cooling off a bit here. Maybe it kisses 60, that sparks some profit taking and it cascades a bit. But if silver crashes all the way down to 50, the silver miners will still be printing money, like literally pulling money out of the ground, real money. So I don't think that would be a disaster at all. I think to the degree that something like that put the silver stocks on sale, again, that would be an opportunity. And what might make that happen? If it's true that, demand out of India is, and front running of tariffs and critical minerals rebalancing, this sort of thing has put a squeeze on the physical markets, I think that rebalances. Again, I'm not a bear here. I'm not arguing against silver, but I think that would be a good thing. That would set the stage again for consolidation before moving higher. And if that's not what happens, if we're really at that blow off top, the good news is, okay, everything will go higher. The bad news is that whenever it, peaks, that we're likely then to go into bear mode for some time. So yeah, again, Mr. Market doesn't care what I want. I would prefer it wasn't the blow off top just yet. But if it is, if we start seeing things going parabolic again and gold confirms silver's move, then actually I would deploy more cash. As crazy as it sounds to say, yeah, I'm going to jump on all-time highs, if we're looking at that blow off top, then yes, I would put more money to work trying to profit on that. And I mean in the stocks. Bullion, I always buy on the dips. That's my savings. I'm always willing to accumulate bullion. That's not what I'm talking about. I'm talking about, speculating for hockey stick gains on the stocks.
How much of what's happening right now, maybe in the last couple of weeks, do you attribute to, it seems like a Fed rate cut is now more likely. It was questionable for a couple of weeks there, but now the betting markets are really saying that, we're going to get a Fed rate cut most likely in December. And also, it seemed like this leak about it's Kevin Hassett, who is likely to be the next Fed chairman. Betting markets have him over 80% chance of being the next Fed chairman. How much of that, with respect to the Fed and Trump and everything, is what's fueling the push, especially for silver higher?
I got a yes and no on that. Clearly when those things happen, the headline about Hassett came across, we saw an instant response in the markets, the broader markets, as well as gold. I don't remember silver wiggle that day, but I do remember that it was good for gold that day. And I think silver was sympathetic. But then things go back to the way they were. And at this point, that Fed rate hike, as you say, that the market's in near certainty.
So what does all this mean for you right now? It means the volatility you're seeing isn't random, it's structural. It means the shortages aren't temporary, they're cumulative. It means Italy's gold confrontation with the ECB isn't symbolic, it's a public crack in monetary confidence. And it means silver is positioning itself for a major repricing event, one that could define 2026. Before we end, here's your question, and your answer could help someone else watching. If silver dips into the $50 to $55 range before launching higher, would you treat that as a warning? Or as the final accumulation window before the real 2026 explosion? Drop your answer in the comments. I'm reading each one. And if this deep dive analysis helped you understand what's really happening beneath the market surface, make sure you like, subscribe, and hit the bell so you don't miss the next update. Events are moving fast, and every week now matters. Thanks for watching. Stay alert, stay informed, and stay ahead.